What's going on, guys? In this video, let's talk about this risk to reward strategy when you're trading futures, particularly the NQ, but this is also going to work on the ES, it'll work on the Dow, it'll work on various other instruments. The only reason we're looking at the NQ is because I personally trade NQ for Top Step, Prop Firm, as well as Apex. If you guys are interested in getting a account funded with a prop firm, check out the link down in the description box below. But what we're basically going to be doing is using the 20 SMA, and we're going to be looking for short-term change in trends. And then we're going to kind of manage our stop loss on a 1-bar stop system. So basically the reason why candle, the reason why we want to enter the trade is going to be any close over or under the 20 SMA. If you guys have been watching my videos in the past, you guys may be familiar with this strategy. So now it's time to start tying it all together in building a trading plan around risk management and proper position sizing. So a lot of times you guys kind of go into the same trades with the same number of contracts. It's not necessarily going to be the same on every trade, as every trade will provide a different risk to reward. So depending on your reason why candle and how big that candle is, two questions need to be asked. Can I enter this trade, and am I comfortable if I do lose with the number of contracts that I'm trading? So for example, if we look at the first trade that presents itself off the bell here at 6:30 in the morning, we were trading over the 20 SMA in the pre-market. We had a big pullback right off the bell. Now, if you notice your 1-bar stop, this is going to be your reason why. Okay, so if I draw a line, this is our reason why candle. This candle here is going to be your reason why. So if you notice, the top of this bar is going to be our absolute max pain. But if you notice the extremeness of this candle, this is a 70-point candle. Now, a lot of traders are going to completely ignore this type of trade just due to the fact of how much risk is actually going to be involved if we do close back above the 20 and we do make new highs. However, it doesn't mean that you can't necessarily take the trade, but what it means is you need to analyze the amount of risk in this particular situation being 70 points, and you need to ask yourself, can I afford to take this trade? And if I can afford to take the trade, how many contracts can I play that I'm comfortable with losing if the trade turns around and goes against me? So for example, if we're going to give up 70 points, which is a lot of points, if we're going to give up 70 points, we've got to be playing micro size contracts. So for every one contract that we play, we're going to lose around $140. Okay, let me say that again. For every one micro contract that you play on this particular setup, you are going to lose $140. Now, if you are okay with that, then you can play one micro contract. If you're okay with playing two contracts, your maximum loss is going to be around $300. Now, the way we're going to set up our take profit is just going to be a sheer 1-to-1 risk to reward ratio. So if we're going to give up 70 points, what we are looking for is to take this trade and either stay in this trade until we get stopped out for the full 70 points, or stay in the trade until we can take a full 70 points. Sometimes on these particular setups, you might get take profit in 5-10 minutes. Other times you might be stopped out in a few minutes, right? But the whole idea behind this is that you're setting up your trading plan in a way where you're going to be able to profit 1-to-1 per trade. Now, sometimes these trades take 2-3 hours for potential price targets to hit, but what it's also going to force you to do is stay a lot more patient and allow yourself to be in the trade long enough to see if it's going to work out. So in this particular situation, if our entry is going to be on this next preceding candle here that I drew this line on, once we confirm the bottom of this 20 SMA play, you would be getting into this play at 6:35 a.m. and you would be sitting in this trade until you get stopped out, or you come all the way down and reach full profit potential on that 1-to-1. So in this particular trade, you would have made 70 points on one contract, which is around $140. Or if you were playing two contracts, close to $300, three contracts, so forth and so forth. You guys can do the math. Now, again, if you're playing and you're trading for a prop firm, you definitely can't take this type of situation and this type of risk management plan and go put on 3, 4, 5 mini contracts. You're going to be stopped out. You're going to be auto liquidated. You're going to lose your accounts. So again, this is a safer way to trade prop firms. This is a safer way to kind of manage your risk. And this is a smarter way that's going to allow you to stay in business and ultimately keep the lights on in your business. So you would notice this first trade is going to actually hit its take profit at around 720, and you would have been in this trade for just about an hour's worth of time. Now, if I take all of these lines off and we look at the second trade that presents itself that actually confirms short on the 5-minute time frame, it's going to be here at 8:15. Now, again, if we're looking for just that one-to-one on that profit target for our risk to reward, then our stop loss on this second trade is going to be 15,943. You can see that our entry is going to be at 8:20 in the morning once we confirm the loss again of the 20 SMA. And if you notice how much risk you're going to give up on this trade is around 20 points. So if we go ahead and we just from entry scroll down here from a price of 15,925 and we go down 20 points, we're going to put our take profit at around 15,905. So if you notice on this particular play, put this price line here, this is going to be your price target line. Okay, and again, you're going to see that this trade hits at a one-to-one in 5, 10, 15 minutes. So versus in 1 hour's time, this trade actually hits in 15 minutes. So if you would have taken these two setups, a potential 70-point winner here on a one-to-one risk to reward and a potential 20-point winner here is 90 points taken out of the market in a matter of a couple of hours worth of trading, right? So if you think about it, if you're able to take 90 points out of the market, you potentially had a $200 winning day trading simply one micro contract, and potentially $400 if you were trading two micro contracts with a very defined level of risk. Now, again, me personally, if I'm able to make over 50, 60, 70 points trading the NASDAQ 100, I tend to stop trading on the day just due to my position sizing. We do have some more setups that kind of take place here. However, some of these setups were a fail. This one here would have lost for around 20 points here. So you would have given back this trade. This particular trade here does hit though, however, for a matter of 15 points. So you would have been back to break even on this trade here. And then the next trade here hits for another, let's see, now we can just actually go through and kind of back test this level here. So if your stop loss on this particular short play was 15,908, your entry was sitting at around 883, you're looking at potentially 20 some odd points here. Let's get the exact math for you guys. So from 83 to 93, 203, we're looking at around 25 points. So let's see if this trade actually hits for 25 points. From 882, we need to kind of drag this down to 62 is 20 points, and then we go down to 60 is 22 points, 57 is 25 points. This would have actually hit as well for another 25 points. So you can kind of see how this one-to-one risk to reward ratio definitely works on the 5-minute time frame. It's also been working for a couple of members and evolution traders on the 2-minute time frame. That's also going to shorten up your risk a little bit because the average true range on a 2-minute candle is a little bit less than the 5-minute candlesticks, and it does provide a little bit more areas of opportunity to take more trades. However, just understand on that 2-minute chart though, you can tend to get chopped up a little bit more when the market is ranging. So it's really good when the market is trading, but when the market is range bound and we're in a little bit of consolidation chop, it tends to get a little frustrating trading the 2-minute or 1-minute time frame charts unless you're really dialing back that take profit from like a 1R to a 0.5R or something like that. But again, I just wanted to kind of highlight here. So you would have had about one losing trade, maybe one scratch trade. You would have had 3 winning trades here and a total of anywhere between 80 to 100 points taken out of the market today. So even playing relatively conservative, playing one option or one futures contract on the micro side of things, which is MNQ ticker symbol, you definitely would have made at least $200 trading today. So again, you don't always have to hit home runs. You don't need to make $500 a trade. You don't need to make $1,000 a trade. You come into the market with this level of confidence, and you come into the market with this level of, you know, being able to control your emotions, because your defined risk is very, very drawn out. You know, pretty much every time you enter a trade, how much money you're actually going to lose on that trade, which is definitely something that I would recommend for newer traders, is to understand your defined level of risk before you even enter that trade. So for example, when you're seeing these trades set up, you can already kind of draw your levels and see how much money are you going to lose if this trade fails. So for example, you know, we're just going to back test this once again. If this particular trade was to fail, you can see on the right hand side of my screen, we're giving up price from 15,924 to 15,944. We're giving up 20 points here. So if this trade closes above this 1-bar stop system, then you're going to lose around 25 points. Now, can it shoot up a couple more points, another 5 points from there? Of course. Wait for the candle to close. I really don't like getting out on wicks. I like for the candle to close, but ultimately the price action will kind of show you if it's strong, if it's weak. You can tend to kind of navigate if you do want to get out when it breaks over the 1-bar, or you want to wait for that full 1-bar to stop. But ultimately, playing one micro contract on this particular setup, you would have lost $40 on the trade, and you were only going to target $40 on the winning side per one micro contract. So I hope this video helps you guys. If you guys want help with this strategy, and you guys want to trade with the rest of the team in Evolution Traders and get access to the rest of my strategies, and you guys would also like to get one-on-one coaching so we can help build out your trading plan, work on risk management, work on some of the mistakes and the focus points that are causing you to not be consistent and profitable, I have one more space available to join Evolution Traders before the year is over. That link is down in the description box below. I'll see all of you guys on the next video.